What do you see when you look at a chart? Do you know where to enter and where to exit that trade? Or more importantly, what don't you see when you look at that chart? Well, this video is going to go over all the candlestick charting basics, so that way, even if you don't know any technical analysis yet, or if you don't know any patterns yet, by the end of this video, you're going to know how to quickly glance at a chart and find your levels of support and resistance, so that way you'll know exactly how to plan out that trade. So stay tuned. So there's two kinds of candles when you look at a candlestick chart. You have a bullish candle and you have a bearish candle. So a bullish candle will be a green colored candle that'll look like this. And then the bearish candle will look exactly the same, but it'll be a different color. It'll be red instead of green. In either case, the candles are going to look exactly the same, just the colors are going to be different. But you need to know the parts of the candle in order to determine what is going on. So there's three parts, and that is the body, and then you have the upper wick and the lower wick. And what these represent is the upper wick will tell you the high in this time frame, because every candle will represent a time frame, whatever you have set to your chart. It could be 30 seconds, 1 minute, 5 minutes, 10 minutes, 15 minutes, 30 minutes, an hour, 2 hours, a day, a week, a month, whatever you have on your chart set. That's the time frame that candle will represent. So we're just going to pretend that these candles represent 5 minutes of trading activity. So in this time frame here, the high, the low, the open price, and the close price. So on a bearish candle, it always represents the price closing lower than what it was when it opened. So for instance, on this candle here, say this price opened here at, say, $5 even. Well, it's a bearish candle and it's red, we know that. So the price has to be lower than $5. So in this time frame, let's say that this price closed out at $4.75. But the high in this time frame hit, let's say, $5.25 and $4.50 for the low. Okay? So the wicks represents the absolute high and the absolute low in that time frame, and the body tells you what the price was when it opened and when it closed. Now for the bullish candle, it's exactly the same but opposite. So this will still be the absolute low of the time frame, the absolute high of the time frame, and this would be, let's say this opened here at $4.75, okay, and closed here at $5, and we'll still keep the absolute high of that time frame at $5.25 and $4.50. So again, bullish candle, bearish candle. Now it's important that you understand that, so you know what you're looking at when you look at the chart, because these are two little candles. When you look at an actual chart, there's going to be much more of them. So understand what they are, so that way you know what you're looking at when you look at the entire chart. So a candlestick chart could look something like this. So now, if I had my chart set at a 5-minute time frame, then every one of these candles would represent 5 minutes of trading. So right now, what I have depicted on this board is 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60, 65 minutes of trading time. So just about an hour's worth of trading time. So if you were to open up any ticker that you chose, that you were researching, that you wanted to get in on, and let's just say you opened it up and you seen something like this. You watched it. The next 5-minute candle came up, and it was that right there. You wouldn't want to take a short position here. and I'll tell you why in a second. Or if you came in and you seen the price action right here at this level, you might see 2 green candles and think the stock is going to run. But that's not the case. You first need to find your support and resistance lines on this chart. So in this little hours time frame, here's what we're going to do. Immediately you can see your support line, right? Because you got your wick here, this wick here, and this wick here, okay? So if you were to draw a straight line straight across, that's what it would look like, okay? That means this would be your support line. And all that is showing is as the bears push this price down, the bulls would not allow it to drop below this line. And they would pick it up and they'd push the price back up. And your resistance line is going to be the same thing. We touched here, which would double top. I just threw that in there. Those are 2 doji candles. And then you draw your line straight over here. So now we have our resistance line up top. That means as the bulls push the price up, the bears would not allow it to cross, and there was not enough buying pressure to push it above the resistance line, and then the bears ended up pushing the price back down. So this is important because if you were to come into this trade and you open this up in this time frame, and let's just say it was right here at this level when you opened it up. Now you wouldn't want to jump in. I mean, you could jump in if you were going to jump in for just a couple of minutes. You could jump in and ride it up to this resistance line. But what's going to happen 9 times out of 10 is in this technical zone, because this is called a technical zone right at the resistance line. Many day traders will start locking in profits and they'll start selling out their shares. And what will happen is this price, as they're selling, this price could do one of 2 things. It could get pushed back down, or there could be enough buying pressure to push it up through the resistance line. In this technical zone, you'll see volume start picking up from the day traders, dumping their positions and locking in their profits. So ideally, what you would want to do is wait to see what the next candle did after it touched the resistance line. If the candle closed above the resistance line, look for confirmation on the next candle and then plot your trade from there. If the candle opened up lower and it's going to head back down to the support line, what you would want to do is take your short position, ride this price back down to the support line, sell out, turn around, go long, and ride the price back up to the resistance. All right, now that I had explained that to you, here's an actual chart of the SPY. It's an ETF that tracks the S&P 500. As you can see up here in the right-hand corner, I have it set to 6 months and 1 day. So each one of these candles represents a 1-day time frame. Now the chart that I had drawn for you represented 5 minutes of trading time. This represents 1 day, and as you can see, I could change it to a week, and I could change the 6-month time frame all the way down to a daily time frame where I can get in on the 1 minute, the 5 minute, the 10 minute. But for this case, I'm going to leave it at the 6 months and 1 day, so that way you can see a big overall picture, and you can kind of see the support and the resistance lines that I had drawn for you already. So starting with the support line, what I want to show you is, and I want to remind you that every support line could have and probably was a previous resistance line. Once the price action breaks above and holds above that resistance line then becomes a new support line, and I'm going to show that to you here in a second. Okay, so now if you look right here, I have this blue line drawn to show you a support that turned into resistance and then turned back into support again. So starting here from left to right, you could see how the bears pushed the price down and it hit the support line, and the bulls pushed the price back up. It hit here. Remember that now this bullish candle it's green, so it closed higher than what it opened. You can see it closed higher than this resistance line. Now you would wait to see the next candle for confirmation if it stayed above the resistance or if it fell back below. In this case, it fell back below the resistance line, so that pattern is now busted. So it fell back down, and you can see it stopped and closed right at the support. Again, it busted through the support, came down and made another pattern here, George W. Came back up, and it hit that support, which turned into resistance, came down, came back up, and as you can see, it busted through the resistance, and it then became support again. It traded sideways, it bounced off the support, came up, came back down, came back up to the old line of resistance. Now keep in mind, these are one-day candles, so this resistance line could last for months. It could last for a year. However long it takes, and whatever chart you have pulled up in time frame, that's the time frame that your support and resistance lines are going to be valid for. So in this case, we're going from September all the way to December. So this is a 3-month support line or resistance line that had played out. So it hit the resistance, came back down to support, never really touched it, bounced, came up, failed again to break through that resistance, pushed back. This candle here closed right at support again, but the very next candle opened up below support, and it traded sideways again. Came back, it broke above the support line, or the resistance line, then became support again, broke back through briefly, came back up the next day, and it was the support line, and we are headed now back towards this resistance line. So what you'd want to see, looking at this chart here, is within the next 2 days, whether the SPY breaks above 410.47 and holds, or if it hits it and gets pushed back down. If the previous close was 405.90, so we're looking for a test of the resistance at 410.47. So we'll see if it breaks above or gets pushed back down below. But I just wanted to show you this on an actual chart, and we could change the time frame. Let's just go to a weekly time frame. This is a 1 hour. Let's go down to 5 minutes, and this is what it looks like here. As you can see, this is trading real sideways in a channel, but this is after hours trading here. And we could scroll back and we could kind of take a look at the same thing here. This line here, you could count it as your resistance. The wicks failed to break above it, and the bodies closed right at it. And then coming down here, same deal. You got your support. So the chart, no matter what time frame, you could always draw your support and resistance lines, and that is going to be the very basic candlestick charting. Now on this chart and most other charts that you use, whatever platform you use, you're going to see these bar graphs down here, and that just represents the volume. As you can see here on this downward trend here, the volume picked up significantly, so that was a very bearish move. But yeah, that's the basics of the candlestick charting. And before you can learn any technical analysis, before you can learn any type of patterns, you have to know what a candlestick chart is. You have to be familiar with your support and resistance lines, and you have to be absolutely sure about what the candle is doing, whether it's a bullish or a bearish candle. So anyways, thanks for watching. If you have any questions or comments, leave them down below. Don't forget to hit that subscribe button. I appreciate the support. And if you have any ideas or any videos that you want to see me make, just leave them in the comments below. I'll get back to you as soon as I can. Anyways, thanks for watching, and I'll see you the next time.